Welcome, everybody, to our November, a little bit longer form roundtable, where we discuss a little bit what's happened over the last couple of months and maybe what to look forward to the rest of this year and maybe into 2024. But like what we always do is a little bit of recap, if you haven't been following, because we have, how the markets have done the last couple of months and maybe even year to date too. And probably have Kyle start with that.
Great. Thanks, Adam. Yeah, it's been an interesting year, really, kind of like we've said a number of times over the last 2 or 3 years. It's the tale of two halves, right? So we start the beginning of the year and we have a tear on the S&P 500, really driven by a handful of stocks, 7 of the tech stocks, and the AI talk and push. So the S&P is up roughly about 18% for the year, but only up about almost 2% for the since June, really. So most of those returns came in the beginning part of the year, and those were driven, like I said, mostly by 7 stocks: your NVIDIAs, your Microsofts, your Apples, your Facebooks, Google. So it's kind of very interesting to see that when we look at an index with 500 stocks in it, 7 stocks making up close to 30% of the weighting, and roughly all of the return. So if we back those 7 stocks up, that index was up only 4% for the year at that point. So definitely interesting and concentrated in one area. For the Dow, it's a little bit more what we seem to experience here. It's up about 8% for the year, 7.5 or so, and about 2 for the second half. And bonds have kind of been our broken record story here. We've had a rough couple years, and now it looks like into a third year here for our fixed income position. So mostly in the intermediate space, but for the U.S. ag, which we talk about, is still down slightly. It's essentially flat for the year, but slightly negative. But a lot of that downside's come in the last second part of this year here, with the down about 2%. So, and lastly, kind of commodities. Those were pretty hot last year with the initial start of the Russia-Ukraine situation and inflation and running up of energy prices. But year to date, they're down about 4%. And that's with them turning positive the second half of the year, being about 4% up. So just kind of been a back and forth year with, strong returns out the gate with a concentration in a handful of stocks. One of the facts that we talked about before here in the office is, look at Apple and Microsoft. They represent roughly 15% of the S&P 500. That's 500 of the largest companies, and 2 stocks make up 15%. And that's the largest percentage concentration for 2 companies since 1980. So, but the average stock in the S&P is only up 1% for the year. And so, like I said, we say not all things are equal. But that's just kind of a recap of what we've seen so far from a market and performance year to date.
Yeah, and you guys may have noticed that we have an extra square here on the roundtable. That's by design. So it's the first one where we've had a guest. It should be fun today. But did want to introduce David Lebovitz, J.P. Morgan Global Market Strategist. Just a quick background so you know who he is. He's a global market strategist on the J.P. Morgan Asset Management Global Market Insights Strategy Team. In this role, David is responsible for delivering timely market and economic insights to clients across the country. Since joining the team, David has helped build the Market Insights program in the United Kingdom and Europe, and has appeared on both Bloomberg TV and CNBC, and is often quoted in the financial press. So a far cry from just us 4. We're happy to have him today, and thought we'd ask him some things that we normally talk about, but these are the type of people that we listen to daily to get our information. We're not just creating this stuff out of thin air. It's guys like David that boots on the ground and really understand it, that help us that stay informed. So thanks for joining us, David. Really appreciate it.
Yeah, thank you for having me. Happy to be here.
So we'll start and go ahead and put you on the hot seat, and why don't you talk a little bit about inflation and maybe views for the future?
Sure. So, speaking of the hot seat, I would say that the inflation seat has been cooling off here quite nicely, particularly in light of the numbers that we got for October earlier this week. And so, we think that a lot of the inflation that we saw during the pandemic, was in fact transitory. It was driven by things like supply chain disruptions. Then in 2022, to your point just now, you had the war in Ukraine, which pushed commodity prices higher. Certain parts of services have seen fairly significant inflation as well, but it does feel like we're coming down the other side of the mountain. Now, I'll say a couple of things on inflation. One is that the last mile of the inflation journey tends to be the most difficult. And so I have two little kids, and I kind of think about it in the context of a road trip, right? You set out and everybody's got their snacks and their iPad and things are going well. And then you get off that exit with 10 minutes to go, and, the backseat is on fire. The last mile is always the most difficult. And I think that that's what we're going to see over the course of the next couple of months. We do think that inflation will get back down to somewhere between 2 and 2.5%. By the end of 2024. And we're really watching three things in particular to gauge that trajectory from where we are today to that point in time. We're watching what goes on with energy prices. We're watching what goes on with wages, and we're watching for any signs that a wage price spiral may be starting to emerge. Now, just quickly on energy prices, we talk a lot about inflation and what that means for monetary policy. The Fed and other central banks tend to target core inflation, which excludes food and energy prices. But the thing with energy prices is that if they go up and then they stay up, that begins to manifest itself in inflation more broadly across the economy. And so given the move that we've seen in inflation or in energy prices as of late, we need to keep an eye on that for any signs that it's actually contributing to more broadly based inflation. The second thing, as I mentioned, that we're watching is what's going on with wages. The unemployment rate has remained relatively low as wage growth has decelerated here over the course of the past couple of quarters. But what I would say about wage growth is that it's right now between 4 and 4.5%, and that is inconsistent with the 2% inflation target over time. And so I think that the Fed does want to see a bit more cooling in the labor market and a bit of a further slowing, I would say, in wages before they really have that confidence that, again, a wage price spiral is not set to emerge. And to me, that's the elephant in the room. Because if you look at what happened in the 1970s, we found ourselves in this environment where higher wages led to higher prices, which then led to higher wages, which subsequently led to higher prices. And once that becomes ingrained in the economy, it can be very difficult to break. And so the bottom line on inflation is that things are moving in the right direction. And we're seeing, some of the hot spots really, really cool off nicely here as we move into the end of 2023. But I would be a little bit hesitant to completely sound the all clear. I still think that there's a bit of a road to be traveled here over the course of the next 12 months.
Yeah, hey, David, on that road to be traveled. So if you mentioned that, if the goal still likely of the Fed is to get wages down and still slowing down and cooling off the economy, then wouldn't we expect a kind of a reverb into earnings and where that could really affect stock prices and overall market direction, as opposed to this? What's your views kind of on that and like this soft landing we keep hearing about?
So what I would say about the soft landing versus the hard landing question, and I'll move on to what that means for profits in just a minute. I really think it's 50-50. Some of the data we look at says, a soft landing does look like it's in the cards. Some of the data we look at says things are looking a little bit fragile in the current environment. Our base case view is that we are going to avoid a recession in 2024, right? We may end up with a recession in 2025, but the next 12 months for us, given the tightness in the labor market, look relatively okay. I don't think that we're going to maintain the pace of growth that we saw, say, in the third quarter, where the U.S. economy expanded by nearly 5% at an annual rate, but I also don't think that we're going to sail off the cliff tomorrow. I think you're going to see a deceleration in the pace of activity over the course of 2024, with those recession risks really building as we look ahead to 2025. Now, in terms of what that means for corporate profits, I think that that's really the key question for investors. And one of the things that a lot of people missed over the past, call it 18 or so months, is that if you're a consumer, inflation is like your worst enemy. If you're a business, inflation is like your best friend, right? It's just another word for pricing power. And so part of what has allowed profitability to continue to grow here over the course of 2023 has really been the fact that inflation is above its long run average. And so as inflation comes down, that will make the profit story more challenging. And it's really going to be up to what companies can do in terms of defending their margin. Right, so managing their labor costs, managing their interest costs, managing their capital spending in an effort to maintain, some sort of decent run rate of profitability. But we do recognize that consensus estimates for 12% earnings growth in 2024 are probably a little bit too high, given our outlook for the economy at this juncture.
Yeah, and you talked about it a little bit, because one of the things with inflation is there's 18 different ways to measure it, and everybody takes out what they want to take out and put in what they want to put in. But you guys pretty much look at the overall inflation basket, including energy, including housing. I can't remember the one I saw, but somebody said that inflation was, again, this is one of those political spins, right? Inflation was way down, but they took out everything that was up. It was energy. How everything that was up had been taken out of their calculation. They called it some different type of inflation measure.
And that's part of the challenge. You know, there are many Federal Reserve banks located around the country. Each of them has their own measure of inflation, you know, looking at median prices, looking at, you know, their estimate of sticky prices versus non-sticky prices. The New York Fed has this crazy econometric model that they run to try to kind of distill the underlying trends in the inflation data. But I think at the end of the day, when you listen to what the Fed and other central banks say, is that they recognize that food and energy prices cause volatility and headline inflation, but people spend money on food. People spend money on gas. And so you can't just strip all this stuff out. You know, it's like people like to strip out shelter in the current environment. It's like, well, a lot of people need to pay for some place to live. So in theory, right, that is still a consumer expenditure and should be included in the inflation calculation, even if you don't like the way that the Bureau of Labor Statistics comes up with that data point.
Right. So I guess on inflation, then that obviously is very tightly correlated with economic growth and the outlook. Do you have thoughts there?
So, you know, again, I think 50-50 in 2024 on recession, leaning more into the idea of a soft landing. The economy just has more momentum than I think anybody predicted. And, you know, as somebody who's done macro research for almost a decade and a half, I can tell you that the models haven't worked as well over the past few years as they did prior to the pandemic. On the recession question,
why is that, you think? Why have the models not worked as well prior to the pandemic?
So a lot of the models are based on kind of long-term trends and more stability in the data. And if you think about what has happened since COVID, macroeconomic volatility has been very high, right? The growth numbers bounce around a lot. The inflation numbers have bounced around a lot. And that's made distilling any sort of trend from the data, which is really what econometric models do at the end of the day, all that much more difficult. So there's definitely been a technical headwind to getting the forecasting right.
Sorry, do you think that has to do with a little bit of the basically government intervention? That, you know, we talk about this a lot, that, hey, if you were in Econ 101, right, you got supply and demand, and it's a pretty simple model. But then when you have these artificial forces like government intervention, all the models break down. I was wondering if that's sort of part of it.
Yeah, I mean, I think that's a piece of the puzzle. Obviously, injecting trillions of dollars of stimulus into an economy is something that we don't have a whole lot of experience doing, right? And that's probably a good thing rather than a not so good thing. But also, just if we go back to 2020, and, you know, we were chatting earlier about the conversation we had back in April of 2020. I mean, that was the shortest recession on record, right? The economy basically stopped overnight, and then a few months later started back up. Like, I think we'll never see anything like that in our careers, in the remainder of our careers. And so part of it, yes, has to do with the government response and all of the fiscal spending, but part of it also just has to do with the nature of a pandemic induced recession, right? Which is not necessarily what you see on average over time.
Hey, David, do you think if we do get pushed out to 2025 potentially, and I mean, really, who knows? This is a little difficult to forecast that far. Would the tail of the inverted yield curve still be in play, the 2 and 10 or the 90-day and 10, or would this be the one that it doesn't work as far as the tell for economic slowdown?
So the yield curve has sounded some false alarms in the past, right? It's not a perfect indicator of recession. I think the bigger takeaway, though, is that it's pretty good, right? And it tends to hit more than it tends to miss. The big question is about the timing from inversion to recession. And if you look over time, it's the average is kind of, 12 to 15 months. But if you look at the distribution of that, it can be as short as a couple of months or as long as, a year and a half. And so I think that the validity of the indicator still very much holds. My bigger question is, what happens to the labor market going forward? And can the Fed, do what they've said they want to do, which is effectively destroy job openings without destroying actual jobs? To me, that's the $1 million question when it comes to the outlook for whether or not we have a recession. And then the one thing I did want to add earlier on the recession question is that, a lot of people, when they hear the R word, they immediately think 2008, they think 2020, right? Recency bias can be your worst enemy. When we look at the cyclical parts of the economy, which really can inform a view on the potential magnitude of any drawdown and subsequent rebound in economic growth, nothing really looks offsides. And so you look at investment spending, you look at housing, you look at autos, you look at inventories, and everything's kind of in line with its long run average. And so, if we do have a recession at some point here in the next, call it 18 or so months, we don't think it would be particularly outsized, right? We think it would be more in line with what we've seen on average since World War II.
Interesting. And so in view, probably the most talked about thing, I think that everybody's followed for the last, whatever, year and a half is Fed policy. So, it's like every time there's a meeting, it's just, it's pins and needles and everybody's waiting and the market reacts. So I think, for a while it was higher for longer. I mean, in your view, does that still hold true?
So here's the way I think about the Fed. If you look at what the forecasts are, so the Fed's own forecasts, then we'll get a new set of them in about 4 weeks here. The Fed's own forecasts are calling for 2 25 basis point cuts in 2024. The market is pricing in 4 25 basis point cuts in 2024. The way that I think about it is, if we don't go into recession, why would the Fed cut for the sake of cutting? I mean, if we go back to the post-COVID or the post-GFC environment, right, we spent 10 years talking about the Fed needing to get rates off of the bottom so that they had something to cut when the economy hit the skids. And you're going to tell me that they're going to cut when the economy's okay? Maybe they ease ever so slightly, but I don't really see that playing out. What I think would get them to cut is if we have a recession. And so to me, the outcome is very binary, where we're either in this environment where rates stay higher for longer, or the plane crashes at some point in 2024 and the Fed responds aggressively vis-a-vis the interest rate channel. But the idea of modest cuts next year, I just don't really buy into that. So I would say still leaning into higher for longer at the end of the day.
Yeah, interesting. What about, so obviously bonds have been hurt for the last 3 years. We're about to go, looks like we're going to be negative for the 10-year Treasury for the first time on record for 3 years consecutively. With this looking like possibly the top of rates, are bonds really back? Are bonds a good place to be going forward?
So we continue to think that there's an opportunity in fixed income, but I will admit that we thought there was an opportunity in fixed income 12 months ago as well. So take that as you will. I think when it comes to the outlook for bonds, I do think that the high is probably in on the 10-year. Even if we get another hike from the Fed, right, kind of a safety hike, not necessarily in December, but maybe at the beginning of next year, I'm not sure that the 10-year responds by going, north of 5.25, which is basically where it topped out a couple of weeks back. So we do think that the peak is in. The question is, what is the outlook for fixed income returns? And to me, if we go back to those two Fed scenarios, right, you're either in an environment where rates don't really move around all that much, maybe long rates come down a bit as economic growth kind of settles back in line with its long run trend, but you basically get the coupon with some modest potential price appreciation. The other environment that we could see ourselves in from a fixed income perspective is one where the Fed is cutting aggressively, rates are falling, and bonds generate a very attractive rate of return. And so I think, to me, going back to one of the things we talked about earlier, you've seen tremendous amount of macroeconomic volatility over the past couple of years, and that has manifested itself in significant interest rate volatility. If we can get interest rate volatility to come down here, that's going to make the environment for bonds much more favorable. And so we recognize that it's been difficult, particularly in 2022 and 2023. We do think 2024, if the economy is kind of finding itself back in more of a steady state, that could allow fixed income to generate better returns than obviously what we've seen over the past few years.
But it sounds like either way, it's going to play a pretty good role. Because, right, if we go into a big recession, I mean, that's obviously spreads widening out, equity struggling, bonds actually, play the role that they're supposed to play in a portfolio, which is, play defense when everything else is struggling.
Exactly. I think it's more a question about the potential magnitude of the return more so than it is about positive or negative. Again, if we get rate volatility down and we get the economy running in more of a steady state, I think bonds will go back to doing exactly what they've done since the late 1990s, which is do a good job of diversifying equity risk in a portfolio.
Right. And we've been talking about too, just the fact that rates are up, obviously, well off the bottom. I mean, in the long run, this is probably a good thing for all investors, just to be able to have, again, where bonds are not a portfolio drag, they're actually additive to portfolio return.
Exactly, and I would argue that having non-zero interest rates more broadly is probably a good thing for capital markets overall. It allows markets to do what they're supposed to do, which is differentiate between winners and losers. And so what might not work as well going forward is the playbook from post 08, right, where you just bought long bonds and tech stocks and you made a killing, right? I actually think that it's going to be more like the environment we were in prior to 2008, where value works a little bit better, international works a little bit better, and bonds are there for both income and diversification rather than just one or the other.
Dave, good segue there. You talked about value and international, both categories that have not been too hot over the last couple of years.
Forever.
If you were just all in
forever.
Well, value I think is still beating the S&P 500 over the last trailing 3 years, if I've got that number right. But it has not been exciting over the last 12 months. If you weren't all in head first into NASDAQ, then you felt like you underperformed. And so what do you guys see as far as where there might be a return to value? And then if you could kind of follow that with a little bit of international, which has just been, like an anchor stuck behind the boat for a decade.
Yep. So what I would say on the value point, and this is somewhat nuanced, so bear with me. I think there's a difference between being a value investor and buying value-like stocks, right? So if you want to invest in value as a style, you're buying energy, you're buying financials, you're buying industrials and materials, and those will work in environments of solid economic growth and a little bit more inflation than what we saw prior to the pandemic. And so one could argue that in the type of environment we foresee going forward, right, an environment where nominal growth is a little bit better, value in theory can generate more attractive rates of return. I also think, though, that there's being a value investor, right? And that's buying stuff that's cheap because you think that it's mispriced. And you can be a value investor and buy a growth stock, right, if you think that there's an opportunity there. And so I would just encourage everybody who's listening, like, don't get too wrapped up in the style box. Like, it is what it is, and Morningstar has benefited from coming up with it. But I think that there's more to the story there when it comes to value versus growth. And it's really about, are you a value investor or are you investing in value as a style? When it comes to the rest of the world, I think that the clouds are breaking. There are a number of things that we see that make us more constructive on the outlook for international stocks going forward. Obviously, valuation, which has been in play for quite some time. Dividend yields are higher. Expected earnings growth is more robust. We do think over the long run, the dollar is too expensive and needs to weaken. But this isn't me saying you should go hugely overweight international. It's more so that we look at a lot of different portfolios, and a lot of the client portfolios we see are actually underweight international. And so this is more about closing that underweight and bringing the two back into more balance rather than it is about initiating, a significant overweight in that asset class. But again, you think about what happened to Europe in the aftermath of 08, double dip recession, fiscal austerity, right? China was kind of doing its best to keep the world economy going, and obviously they're dealing with some issues there. So it's not like the shirt is completely clean, but I do think that the outlook for places like Europe and Japan and EMX China has very much improved relative to what we saw over the course of the past 15 years.
Good. You guys got anything on that?
Well, I think, part of the excitement around the U.S. too, though, has just been we've been the concentrator of growth. We've created $6 or $7 trillion companies, and I don't believe, I'd have to check my numbers here, but I don't believe in Europe they've created $100 billion company in the last 20 years. Most of the companies that are valued more than 100 billion there right now are 20 years or older. And so if the growth is not occurring there, does it make sense to weight investments there just because the PEs or the PEs are lower, the stocks appear to be cheap?
Well, I think you need to differentiate between buying the beta and investing to try to generate alpha. Because if you think about some of the companies that are domiciled in Europe, they're very growthy, right? And they'll play a significant role in what's happening and what will happen going forward. I'm thinking about a certain semiconductor company that's based in the Netherlands, right? You think about some of the luxury goods brands. Like I take your point of, okay, so the past 20 years have been kind of tough, and that's because it was all about the banks in the early 2000s, and then the banks completely blew up, which kind of left this like pothole in Europe that they had to figure out how to fill in over the past decade plus. But I do think when you look at some of the companies that are domiciled in Europe, right, they're very global by nature, and they're frankly pretty solid. And so this is less about, hey, Europe's cheap, so you should buy Europe. It's more like, hey, there are some really good companies out there that may be trading. This is back to my point about being a value investor, right?
Yep.
That may be trading at a discount relative to their intrinsic value, and you don't want to forego those opportunities simply because international hasn't worked in recent times.
What about currency? The dollar's been so strong for a really, really long time, and obviously that's a big factor in U.S. versus international performance when you're comparing the two. You guys see the dollar weakening at some point?
So we think in the short term, the dollar probably continues to strengthen. The U.S. is the best house on the worst block. We have higher rates, we have better growth, and there is uncertainty out there, right, which tends to support the performance of the USD. When we think about the long run, though, it's really all about the country's trade balance or current account balance. And the reality here is that the United States runs a chronic current account deficit. And so, put differently, we are a net borrower of dollars from the rest of the world. And what that means over time is that the dollar should be getting weaker rather than continuing to get stronger. So structurally, right, part of the argument for owning international is that you're going to get more of a currency tailwind than has obviously been the case over the course of the past 10 to 15 years.
Yep. Understood. Well, other things going on in the world. Well, we're in another Middle East conflict. Not that we've had one very recently. There always seems to be something going on. Again, not a political judgment. That's not what we're here to do. But we do manage money, and it's about markets. So just some examples of other times of turmoil in the world, how markets reacted.
I actually go ahead, David. I'm sorry.
No. Go ahead. Go, please.
I would say I had a slide I wanted to bring up here that talks about that, because we get clients calling in all the time whenever there's some news out there that's, whether it was Russia and Ukraine, whether now it's what's going on with Israel and Hamas. I mean, there's always some sort of conflict going on, or when it does, the calls come in. Okay, well, is this the next World War III? Is the world coming to end? What's this mean for the stock market? What's my account going to do? Do I need to go to cash? Those calls and questions that come in. And so, looking back, we never want to say that wars are good by any means. Sometimes they're necessary, but we're taking kind of the human element out of this, and the fact that there is loss of life, and looking more just from a technical market standpoint and what the impacts have been, historically. And so we remind clients that, news can cause markets to react short term. People panic. There's that knee-jerk reaction. Markets sell off. I go back.
I think recency bias too, Kyle.
Yep.
Recency bias as well. I mean, every single time this occurs, it's always like, well, it's never been this bad. It's
right.
This has never happened before. But I mean, that's what we say every single time, because it
this
feels
time
fresh,
different.
and it's absolutely awful this time. But I'm sure that many of our folks, I mean, if we could go back in a time machine, would have said it about many of the awful wars that have occurred.
Right.
And I think the key thing when it comes to geopolitical conflict is, again, not to minimize the human element of it, but from an investment perspective, you need to think about, what that means for the markets and the economy. And so we always think about the channels by which geopolitical conflict can impact the markets and the economy. And there are basically two, right? It's commodity prices and it's government spending. And so if you're trying to figure out what the impact of the current situation is going to be, watch commodity prices and watch what happens with respect to fiscal policy, particularly around defense. But we try to, and I think that chart did a great job of highlighting that markets tend to get over this stuff relatively quickly unless it breeds a much more significant issue vis-a-vis commodity prices or fiscal expansion.
Yeah, let's bring that chart back up. I kind of wanted to talk it through for those of the people that aren't actually watching, that are just listening to, and kind of essentially what the chart's showing is, the past 10, 11, 12 conflicts, whether it be Pearl Harbor, whether it be the U.S. terrorist attacks, Boston Marathon bombing, even Russia, Ukraine, all the different wars or conflicts or events that have happened and going back. And essentially we look at those, and there's times where 9/11 we had a 5% one-day drop in the market that hit the heart of New York right there, right? So the whole market exchange panicked, everybody panicked. And then Pearl Harbor was another negative 4%. But historically speaking, looking a little bit further out from these events, the 1 year numbers are usually positive, with the exception of the terrorist attacks on 9/11. Max drawdowns, usually stuff we experience throughout the year on a normal year, 10%, 6%, 12%, with Pearl Harbor, it was 20% was kind of the lowest that we hit in that period. And the highlight here is really just how long does it take to essentially reach bottom and then also recover. And so most of the times those bottoms are hit relatively quickly. And as we saw, not too severe, nothing like we experienced in 08. And then the days of recovery, I mean, in every instance, it's been less than a year that the markets, were back above where they were prior to. And so that's just, obviously it's history. We can't say that's going to happen every time going forward, but it's something we definitely look to and reason with when clients call on regarding, okay, what about this time?
Well, David, to your point about commodity prices, I mean, late September, crude oil's in the low 90s. We're around $73-$74 today. So that's a lot of that has come off, even though there's conflict over there right now. And that probably just points to, it's pretty localized. If it spreads and gets bigger and bigger and we have more problems, then that's going to lead to a different outcome, I think.
Yep, I think that's spot on.
Yeah, and like Jason mentioned with recency bias, we were at a conference one time and they were talking about just how you tend to think that this is going to be worse. This is worse than it's ever been. And the truth is, it's actually probably better than it's ever been. One of the things they talked about was danger. That it was very dangerous, and people tend to think that the world is as dangerous as it's ever been. And the truth is, it's actually as safe as it's ever been. There are less people losing their life today in wars and conflicts than ever before in human history. And you go back to, in modern times with World War II and back through the 1900s, but then you go back to, the Genghis Khan era and Napoleon. I mean, large percentages of the world was passing away from conflicts, from disease, from all kinds of things. And again, now we're actually at the safest time in human history. Although, like we've talked about, no war is good, no loss of life is good, but it's not different this time in a negative way. We're actually, like I said, we're actually probably better off than we've ever been.
We're the safest we've ever been, but we're also the most aware we've ever been, and I think that's what puts a huge spin on it. Is that even though we're the safest we've ever been, it feels the most dangerous just because it's in our eyeballs, and we didn't have access to that, 10, 20, 30 years ago, and that's when we actually felt safe. Doors were unlocked, things were like that, when actually it was probably a far scarier time. We just didn't know about it, and now we know about every single car accident on planet Earth. And so it seems worse than it is.
Yeah. And same with the markets, right? You could only read the newspaper and figure out what the market did yesterday. And now you can watch it, 24/7, at least all market hours, and then get the recap afterwards and the pre-cap the next day, and on and on and on. So
don't forget futures and after hours too.
The futures, yeah. We got to keep it going. So on another note, again, we try to talk about things that are sort of relevant and things that are happening in culture and in the economy, the markets, in the world. Recently, so Dave Ramsey, everybody probably knows who Dave Ramsey is, popular talk show guy that talks about investing. He was talking about basically a safe withdrawal rate in retirement, and his number was 8%, and he's just gotten absolutely roasted over that. But we talked about this a little bit. 8% safe withdrawal rate. Now, the part that most people are failing to mention when they bring up that safe 8% withdrawal rate was that he thought you could get 12% return on just a good growth fund. So average annual return of the market, David could talk to this, but you go back over any period of time, you're not getting 12% on the average annual return of the stock market. If you go longer, if I remember it right, if you go way back into the 1920s, maybe you could get up around 10%. But typically, if you use a more recent period, call it 40, 50 years, you're in the eights. So 12% is not a very good number. And again, to talk about what we do, you could take out any amount of money you want. I mean, an 8% withdrawal rate, if you just take out 8% of what you have on math alone, you'll never run out of money, right? If you get down to $100, you just take 8%. It's $8. I mean, you won't spend very much. You won't be able to do anything, but you just keep taking 8%. We're not in the business of guessing with people's money. We're in the business of high probability and making sure people are successful. So I think there's been a ton of numbers run, Jason. I think you had some of them on the 8% withdrawal rate and a Monte Carlo simulation and how many times that would work out.
Yeah, and what's not fair too, and Ramsey didn't disclose this, is what percentage of retirees have 100% of their assets in growth stocks and are perfectly able to tolerate the swings that growth stocks provide. Because if you wanted to find a stock fund, even just being all stocks, and you could average, let's say, something north of 7 or 8%, you have to be a retiree with no more money coming in, no more income coming in, and be able to tolerate 10 to 15% annual corrections and 20 to 30% corrections every 5 years. That's just how it works. And very, very few people could tolerate that, let alone stay that way for the course of their retirement. And so what's more likely is that you're in some kind of balanced fund, balanced portfolio, stocks, bonds, real estate, cash, et cetera. And your rates of return aren't going to be as high because your predictability is higher. And that's really what you're buying, is the peace of mind and the predictability, because you don't have more income coming back in. And so if you're an all stock fund, and let's say you could average about 8, I would say a balanced fund is going to be something south of that, maybe something more like 5 or 6%. And so if you start doing these simulations, okay, what if I invested that way? And I started taking these Ramsey suggested withdrawals, even if you did stomach and have it all in the S&P 500, 56% of the time, your balance in your portfolio, you ran out of money inside of 15 years. Over half the time. And if you had a balanced portfolio, like most folks do in retirement, they're not in their 20s putting it all in growth stocks, you ran out of money 100% of the time, usually very quickly, especially if your timing was just unlucky. You retired right before the great financial crisis. And so you're starting to withdraw right before or right into the market going down. And so that's where you got to kind of take these with a grain of salt and really look into it. Call us. We'll decipher it for you.
Well, I think too, the other part they don't factor in when you're talking about returns and whether or not you're concentrated in growth or balanced portfolios. Like you said, most retirees don't have 100% of their net worth in after-tax monies, right? So you're drawing 8% on your IRA, and then you're paying taxes on that money too. So it goes a lot, not quite as far as they make even with the 8%. But I think that goes back to kind of what Adam was hinting at, and Jason, that the importance of planning, right? It's starting on where you're at today, where you want to go, and then coming up with solutions on how to withdraw assets and what that reasonable withdrawal rate is from a portfolio based on planning, not just, hey, you need $2 million to retire and draw 8% a year and we're done.
Yeah, and I think 44% success rate, that sounds like casino odds to me. So that's not our business, but and we don't even provide free drinks. So if you're looking for 44% success rate, you can play craps or blackjack, but that's not something that we're doing. So that was just an interesting comment. Again, Dave Ramsey is in the business of media. If you didn't know that, he's not in the business of managing money. He's in the business of media and more eyeballs and more clicks and more talks. He's very successful at what he does, but I'm glad he's not advising some of the people that we're working with. On that note, let's talk WeWork. Chris, you want to talk about WeWork a little bit?
I think we should probably pass on WeWork. Obviously, it's in a bad spot, and we can probably have one-on-one conversations about WeWork. It's probably the best thing to do this round.
Okay.
We can talk about market timing though. You want to talk about market timing?
Market timing. So yeah, I mean, here's the thing. So the example was really just single stock risk. The one thing is that you have with a diversified portfolio is many opportunities. Obviously you're hoping to earn a return on, if you have a stock portfolio and there's 200 positions, you're hoping that all of them do well. But if one of them doesn't do well, that's 1/200th of your portfolio. And the return is the average of all those returns over, in a portfolio. With any single stock, you can do really well. I mean, there are examples. I mean, everyone knows them. You heard the secretary who started at Microsoft and, got shares on the ground floor and is, multi-millionaire. I mean, things like that do happen. But also with single stock is the risk of complete failure. And it does happen. We don't hear about it a lot, but Enron and other countries, it does happen. And when we talk about declines in portfolio value, it's typically a temporary decline. So portfolio values are down, but nothing is bankrupt, right? The price per share is down on whether it's stocks or the valuation of a bond, but the bond's going to come due. The company's still running, can still earn money. When you're talking about an individual company, once they hit rock bottom, there's no hope of recovery. So it's just a completely different investment strategy. Single stocks. Again, this is not something we do, but everyone hears of the great investment in some company that went to the moon. You just don't hear of the investment that when something was worth $40 billion and the next in a couple of years later it's worth $25 million. It's just it's a big difference.
It's worth repeating too. Diversification is getting away from concentration in either certain sectors, certain countries, and certainly not having it all in one stock. But like Kyle was talking about earlier, if you strip out just a few of those companies in the S&P 500, that again, people try sometimes to concentrate their holdings in just the winners. You might be down to 4 or 5 or 6 stocks, and if that part of the market then declines, Jason's number of minus 20 or 30 is probably mild. You don't have to go back very far to find sectors that are down 50, 60, 70%.
12 months.
When they just fall out of favor. It's just
Right.
a matter of, well, we'll go somewhere else for a while. There's a sector rotation. And then you go, well, what happened to semis? I thought semis were the hottest thing. And now, nobody wants to hold them. Oh, they're back, 12 months later. So that's the rough part about concentration, whether it's single stock or single sector or single country, whatever it happens to be.
Well, Chris, I think we've hinted on that past, right? And perfect, short-term examples, clients look at year-to-date numbers. And I think it was Jason and I on one of the monthly market matters that we discussed it. Everybody's like, well, what's year-to-date? If it's January 10th, it's 10 trading days. If it's now, it's 9, 10 months, 11 months worth of the year. Year-to-date's just a number in time. But if you expand things to a 1-year number, or 3-year number, or 5-year, you get more a reasonable sample size. And for example, we look at Amazon, right? So up 50% at one point this year, down 40% last year. Everybody 6 months in, why don't we own more Amazon? Why don't we own Nvidia? Well, nobody wanted to own Amazon last year when they were laying everybody off and down 40%. So if you expand those numbers sometimes outside of the 6-month calendar year we're in and go to a 1-year number, things average out.
And just to pull those two ideas together, one of the things that we've seen, if you look at stock and bond returns back to 1950, is that, to your point, over any given year, you could be up a lot or you could be down a lot, right? And it's really anybody's best guess. But as you begin to look at things over a 5-year rolling period or a 10-year rolling period or a 20-year rolling period, we actually have found that since 1950, there is not a single 5-year rolling period where a 50-50 portfolio of stocks and bonds lost you money. Right. So diversification smooths out the ride. It improves your chances of success. And if you can keep the ride more comfortable, right, then you keep people invested. And if you can keep people invested, then they subsequently improve their chances of accomplishing their long-term financial goals. And so it's that combination of diversification and time horizon that really leads to long-term investment success.
And we say that all the time. The goal is to try to keep people in, because a lot of times it's that uncomfortableness is when we make our bad decisions. And we've said it a million times. You got to time it twice, right? On the way out and the way back in. So if we can keep clients in, knowing that over time it typically works out in their favor, that's better for them in the long run too.
For sure. So top questions from clients. We normally do this just to, again, if somebody's got a question, there's probably 10 or 20 other people that have the same question, just haven't answered it. You guys got anything recently?
Well, you hinted on the war stuff. I know that's usually been front and center a number of times. I think Chris had one, didn't you?
Relative to war? I don't think
so. No, a different question.
Well, I was going to speak a little bit on market timing.
Okay, go for it.
There was one chart that I saw this last week. If we can pull that Vanguard chart up regarding best and worst days. So we get this sort of inquiry all the time. Well, if certain things happen, let's go back to the beginning of October. Things are going to get really questionable in the Middle East. Maybe we should just sit out for a while. And so you have the sort of a deep conversation with clients about it's important to stay in. And well, I'll feel better if I'm out for a little bit. And so what this piece from Vanguard sort of illustrates, going back to 1988, is if you just would have stayed invested and missed no days. Is that chart up right now? I can't see.
Yes,
Yeah,
it
it is.
Okay, good. So if you stayed in your average return over that period of time, and this is using I think it's the Vanguard All Stock Index, but let's call it the S&P 500 for our purposes. You're up about 10.5%. You start missing just the best days, and just a few of them, your average annual return goes way down. Now, Jason and I can probably mix this up a little bit, but Jason would argue you could also miss the best, or excuse me, the
worst trading days.
The worst trading days, and you could really enhance your return. The problem is that the crystal ball is consistently broken in terms of what's coming next. Because
see how easy? All you have to do is just miss the 50 worst trading days, and you double your returns.
yes, yeah, and that is substantial.
Well,
one of the
bottom
favorite
chart-
pieces I have in my desk is a piece from San Francisco Chronicle from, I think it's from 1987, and it's on one side of it is the crash and everything, and the next side, and the other side is the next day's paper front page, which is Jubilee. Everybody, the market's up 6% or something like this today, and it's always broken or perfect, and we just don't know what the next day is going to hold.
Oh man, that reminds me. That's so tough. It's almost cringeworthy when you're watching like CNBC, and I know the clients feel this too. I feel that there's only two words they ever describe a stock or even the market.
Plunging.
There's only two: plunge. Well, plunge
Knew it.
or crater. Crater is the word that they love. I remember I think I was just getting ready, and the TV's on in the background. And I'm trying to get into work, and I can hear on the news the market is cratering. I'm like, oh my gosh! I go turn around, I go look at the TV. And the Dow is down like 60, down less than what, a fraction of 0.5%. But according to that journalist that was on, the market was cratering. Or the other one that they love to use on a day that the market is green, that it's rocketing. It's just rocketing up. It's up 1% today, and then the next day it's cratering. It's like I get it why the clients get worried, and they get, because this is what they see.
Yeah,
it makes
and
it
just
tough.
One thing to add to that, if you pull that Vanguard chart back up, if you look at the bottom on the daily return since 2020, the other thing that I would highlight is that the good days and the bad days tend to cluster together, right? So Jason, to your point, the market craters one day and then it rockets the next day. Well, like, none of us are good enough at this to be in on day one and out on day two. And so that just further kind of supports the idea of getting invested and staying invested, because the idea that you're only going to hit the good ones and miss the bad ones. I mean, if you could do that, then you should go start a hedge fund, in my view.
Yeah.
Well, and then think about it this way. How many times you had a client call in a week where the market's been up and they say, why is the market up today? I don't know. Nothing came out new. The market just went up today.
I don't get those calls.
Oh, you don't?
I've had no one call and ask me why they're making money.
No, not why am I making, but what's driving the market? Like, markets
Yeah.
can react on the smallest things. It can even be just technicals and momentum, and not even necessarily news. So I think that's part of it. There's no way to time something that's unpredictable with certainty like that. So
Go ahead, Ed.
I was going to say, in case anybody missed it, David is a global market strategist. Again, he's removed from what we're doing and doing this stuff daily, and he's saying, stay invested. Our clients don't know, but they're always looking for the person who can time the market, who has the crystal ball, and those people just don't exist. I mean, there's nothing wrong with moving your money around to different segments of the market, but thinking that what's going to happen tomorrow or this week or next week. I mean, if you missed it earlier, he said that, hey, we thought bonds were going to be a great place to be 12 months ago. Again, experts they have a good read, they have a lot of data, and they're very smart, but it doesn't mean exactly what's going to happen. So
replicating that too. Let's say you timed something and you got it right. You did it right. How do you replicate that? Did you read a certain article? Did you just have the right breakfast? Did you see something on Twitter? Did you see the right news article? How do you replicate the fact that you timed it correctly?
Gut feeling. It's all goes on gut.
Yeah, I think that goes back to the day trading thing. That's where the day trading thing, which if you ever talked to anybody who's day traded or heard about day traders, it's basically the same story every time. They mistake luck for skill. You do something and it works, and you do it again and it works, and you think you're really good at it. And the truth is, it's really a bunch of market forces that you don't really even understand. And you continue to increase your bets until one day it only takes one opportunity for it to go sideways, and they're wiped out. And it's literally the story of almost every day trader, that they started small, did well, built up, Next thing you know, they're in options because you need
Back to
leverage,
work.
right? Yeah, exactly. And you're out of money. You're wiped out. So just not possible to time the market. Anything else on client questions?
Yeah, I've got another one. And this is for probably most of our younger clients, or maybe even some of our clients' kids. We're in a part of the market right now, jumping over to real estate. We're in a part of the real estate market that we've never seen before, where the affordability is the worst U.S. history, maybe, at least in our lifetimes. And the question I've got from younger folks is, should I try my hardest to try to buy a home right now, or does it make sense maybe to rent and try to save some money? Everything is just unaffordable, and it's very, very difficult for younger folks to get into a home. So I've got a chart here that shows a buy versus rent. And what you're looking at here, even though rents have gone up, and anyone who's in the rental market or looking to rent a home or apartment will tell you that it has gotten more expensive to rent. No argument there. But if you look here on the cost to buy, it's dramatically different. And the two drivers of that is going to be interest rates have doubled. In some cases, nearly felt like they've tripled. At the same time that housing prices have gone up 50%, some more, some less, depending upon the markets, just within the last couple of years. So when you have interest rates doubling and home prices up 50%, the cost to get into a brand new home, or any home rather, is dramatically more than what the increases we've seen in rents. And so without knowing everyone's individual situation, my kind of high level advice, if you're looking to get into a home at this point and you're currently not in a home right now, the math says it still makes sense to rent, save money. And so that way, maybe you could get into a home with a larger down payment. You're not having to finance as much if the rates are still around 7 or 8%. But those would be kind of one-off questions, but just very high level, I think it's interesting to see where housing affordability has gone.
Yeah, it looks like in 80, according to this chart, in 81, it was probably worse. And going back to 06 is about as bad as it's been, as bad as it shows now. But yeah, 81 or those are the times when clients talk to us about 15% mortgage rates,
and they were happy,
and 18% CD rates. And I'm really hopeful we don't have to see that again.
I don't have the chart, Chris. Now, you made a point as far as it being out of whack on the buy versus rent, but I think this is the worst we've seen as far as percentage of take-home pay going towards housing. I think right now in this country, we're 44% of the average American's paycheck goes to housing. That old rule of thumb we always used to hear about where, it was like a third or 30% of your income would go to housing. Now we're up to nearly half. And that's just because of the rates combined with, when we saw back when we talked to some of our older clients and they had their first mortgages in the teens, the one thing that was drastically different then is the housing price, right? Folks were buying their first house for 30 grand or 40 grand or something like that. So the one thing though, that's a little gray or cloudy with this information is the one thing that's changed in America is most people, their first home was like 1,200 square feet. Quite often, 2 kids slept in the same room. And so not only what's happened in America is most of us live in bigger homes now. And we've seen the average square footage of homes dramatically increase throughout the country as well. So the price per foot in a house hasn't gone up that much more past inflation, but home prices as a whole have gone up because the square footage, we're living in much larger homes now. So that affects affordability as well.
To that point too, on the percentage of their income that goes to homes, that's right in line with kind of that max range for qualifying, right? That 45% income level there for your price of your mortgage. So it seems like
they'll probably move it, right?
Whatever your
they're
max
going to make
qualifying is what the house you're looking for.
Well, the banks will figure something out, whether they're going to figure out that they'll increase that, even though that'll take more risk for them, or maybe they'll develop some 40-year loan. I think what would be creative, although this isn't in the bank's interest, is that if you could sell your mortgage, when you sell your home, and then that would probably open up the market, because right now who's going to sell their home? That's why there's no inventory, because everyone's got a 4% mortgage or below, so they're not going to move. And it would make sense if you could sell your mortgage, but the bank doesn't want to keep carrying that 3% mortgage. They want it to pay off and then reissue someone at 7.5. So
for sure.
Don't know the solution there.
Anything else? Predictions?
Oh, these are dangerous.
Uh-oh.
I'll put that on David.
We actually were decent last time. We'll go with David first. I'll tell you what last times were. Jason said maybe 1 rate hike, steady housing market, tech correction, which by the way, since our last one, we've had some. We just recently sort of came out of a pretty significant down period in the market. Kyle, no recession coming. Haven't had that. I said rate hikes will lead to a down market in the back half of the year. We've sort of seen that, but again, just pulled out of it recently. And I think that was part of what David was talking about earlier, that the market's always pricing in, oh, well, we're going to have 4 rate cuts next year. If we don't have any rate cuts next year, that could change. And then Chris said value over growth, slightly lower 30-year mortgage rates. Did we get that, Chris?
No, we didn't.
Well,
if we would have waited maybe another 2 weeks, we might be able to get
Unsuccessful.
Hey, it came
It
out
looks
lower,
like this right
lower
now.
than it was a few weeks ago, but not lower from our last prediction.
Not
It
enough.
went higher, now it's coming down.
It's all
Not
that
enough.
timing, right? Bad timing. We should have have the roundtable a little bit later.
True.
David, you want to start because you're smarter than all of us.
Sure. So I think that there's one more rate hike coming from the Fed. Maybe not in December. Maybe it comes in January of next year. But, I get the sense, having listened to Powell over the past couple of weeks, first it was, well, rates are up, equities are down, the market's doing our job for us in terms of tightening financial conditions. And now that whole thing is completely reversed. And so I think the Fed is probably a little bit uneasy here. And again, the biggest mistake they could make is stopping the tightening process too soon and then have to re-engage at some point down the road, because that'll just mean more economic pain. So I think the Fed errs on the side of caution, and we get one more rate hike before they go on an extended pause.
And what do you think that does to the market? Does that completely transform their view of 24, or is it just like, oh, okay, we had one more, and then but we're eventually going to start moving down?
So I think it probably will weigh on longer term yields, because the market will begin to get concerned that the Fed is overdoing it and that growth will slow more significantly than currently seems to be in the price. And I think, equities will bounce around a little bit if they do one more. But let's not forget, there's one more hike in their forecasts as of September. And so it's information that they've put out there. The question is whether or not it's been fully digested. So a little bit more volatility, but probably lower rates at the end of the day, which is good for asset prices overall.
Jason?
Oh, predictions, man. This has been incredibly difficult. This year, in my career, we've all been doing this a similar amount of time, going back a couple decades now. But what's so different this year is just the divergence of investments. Usually we use that metaphor of all boats in the same harbor. Stocks are up, stocks are down. They generally move together. But what a divergence this year when you look at like large cap, large company tech stocks, the names we are all familiar with, and then you compare that to smaller companies, smaller and middle-sized companies. The Russell 2000 as an index, and they couldn't be moving further apart. Oil and water. And so it wouldn't surprise me if the rates stay a little bit higher for longer, which I think that's going to put pressure on these, in my opinion, slightly overpriced tech stocks. I think they could come out of the clouds. It wouldn't surprise me if, I know we all are all moving towards AI eventually, but the speed of it might not quite be as fast. I don't think all of our clients are going to be using ChatGPT 4 and 5, immediately. So I think things may slow down a little bit. I think bonds are a great spot to be, because I agree with David that I don't think rates are going to be dropping down tremendously fast, but I don't think they're going to be going much higher either. So it's nice now to be in bonds, clipping a coupon somewhere between 4 and 6%, depending upon the bond fund. So I think bonds are going to be a good spot to be over the next 6 months, and it wouldn't surprise me if tech comes out of the clouds.
Well, I was kind of hinting on what I was going to say. I think that Chris talked about value coming back into play, and I think that regardless the recession hits in 2024 or 2025, I think that value is going to kind of start coming back into play. People are going to be looking for that a little bit more stability in that cash flow on there. So I think value will have I don't want to say better run than growth, because growth is red hot, but I do think growth is going to come down, and we're going to start getting some positive returns a little bit higher here in the value side. And then too, like I agree with the fixed income. I think bottom line is that if we can get 4 to 6%, and I think most of the downside that I would expect to see in the fixed income market, we've already experienced, regardless if there is another rate hike, 1 or 2 more. I think that's kind of priced in at this point. So I'm hopeful and optimistic that we'll actually see some principal appreciation in the bond market as well as the higher coupons. So I think that's finally something that we'll see here in 2024.
Real quick, Kyle, you mentioned the R word again, right? Like it's so consuming for us. It's so consuming because the media drives the conversation. So then the clients have concerns, rightfully so. But, even as David was mentioning, we may not even see some until 2025 now. Turns out then, recessions fall into our laps about every 5 to 8 years. And so we're going to talk and talk and talk and talk. And it might have just being normal where we end up seeing one every so often, but we just never stop talking about them.
Well, that goes back to our market timing and that we talked about, right? I mean, if we thought, for the last year and a half, they talked about recessions and we should have got out of the market because recession's coming, and here we are today.
David, I don't know where JP Morgan was, but 12 months ago, right? 2023 was the most predicted anticipated recession that never happened. And I'm sure JP Morgan was in the camp too, where everyone was calling for a recession first quarter of 2023. Do you recall how that, because I'm sure everyone's backpedaled on that statement.
Yeah, no, I mean, it was very consensus to be expecting a recession. I think where everybody got it wrong is that we all should have gone totally pro risk when the Fed injected $500 billion of liquidity into the system to address what was going on with the banks, right? When rates fall by 50 bips and the Fed adds liquidity, like we've baked those cupcakes before. We know exactly what happens. And to my mind, that was just something we talk about this, like we all missed it because we were so consumed, to your point, in this idea that, there's inflation and an aggressive Fed and the economy is going to have to crack. Well, the Fed kind of rode to the rescue somewhat indirectly. And I think that's a lot of what gave this expansion additional legs.
And that's what's kind of funny is that, so you're a strategist, and now instead of talking about, again, this is back to that Econ 101 thing, instead of talking about things that actually drive the market from an economic standpoint, it's these artificial things. We miss the opportunity because the Fed put money into the system. Again, if you're a client or somebody investing, this is the stuff that you can't predict. And so even more to the market timing thing, if you're an economic expert, you know exactly how markets work and you know exactly how math works. You cannot predict how governments will act. And the Fed is part of, Federal Reserve is part of that arm. So, David just mentioned, hey, we missed the opportunity because, they injected liquidity and then prices go up. Well, that's not really something you learn in economic class. Chris?
Yeah.
I'm with Kyle. I mean, I think value over growth is probably still a theme going forward. I think, clients hear it, want it, in terms of having a dividend, having cash flow come in too. And that tends to, lend itself to value style investing, even though, as David said earlier, you can be a value investor when certain growth stocks, fall out of favor. And that's happening. I would guess there's probably a couple of really big names today in the market that are down considerably that probably just fall into a value screen like immediately because they've gotten a lot cheaper as far as the stock price goes, and it's still a great business. So that's really opportunistic value buying is probably the name of the game. But
that cuts both ways too, because you have a lot of these growth stocks that start paying dividends, and it doesn't make them value stocks.
That's right. But yeah, I think we're definitely going to have lower mortgage rates in the future. Also, I think if you look at where we are today, even versus a couple of weeks ago, I mean, it's really come off of a high, and I don't know that's going to spur a ton of real estate activity, but most of those are hinged to roughly to the 10-year Treasury. And the 10-year Treasury, if like David said earlier, the top is in for the 10-year Treasury, that means we're probably going to have lower 30-year mortgage rates. So
I think though, Chris, clients ought to be aware though. I would say that the days of 2.75% mortgages and 3.25% mortgages, those may be gone for life. And so, but 5.5, might be in the cards. And so keep that in mind if you're looking to buy real estate. I wouldn't sit on the sidelines and wait for those threes. You may not see them, but I do agree with you that the rates ought to come down. I forget the article I read, but normally 30-year mortgages, because they're kind of pegged to the 10-year, there's usually a spread that holds them pretty true. But the spreads widen right now, where mortgages were close to 8 when the 10-year Treasury was at around 4.5 to 5, and that spread is larger than it has been in the past, probably because of the fear that the banks have. But that difference between the two should close, which would bring mortgages down.
Well, it's like anything. It's not a single factor. If you want two and a half year, or excuse me, 2.5% 30-year mortgages, you have to do a massive amount of damage so that the Fed has to come in and go back to 0% interest rates. You don't want that. You want things to slowly go in whichever direction, and having 2.5% 30-year mortgage rates is not something. I don't want everything that comes with that to get back to
Right.
that point.
Correct.
Yep. So yeah, the only thing I'll add is after listening to David and all this stuff, I'm not sure we'll get any rate cuts in 24. If again the economy is doing better than expected, again they want to keep rates up. They want to continue to bring inflation down, and if we do have a sort of a soft landing, or at least it gets delayed into 25, we may not see any rate cuts, which isn't a terrible thing. I mean, it's not going to give any extra juice to bonds, but it means the economy is doing well. It means there are fixed income investors, which is a lot of our clients because they're older and they have balanced portfolios, are going to earn a good return on fixed income going forward. So there's definitely a silver lining to that. So that's mine. I think there's going to be no rate cuts. And again, this can change like the wind, right? But no rate cuts in 24. We'll see.
Adam, one thing on that. That's another thing we mention it on most podcasts. If we don't have rate cuts, this is another reminder for people to go take a look at their cash. Wherever you keep your cash at, you shouldn't be earning zero on it. Unless it's in your short-term checking, you should be earning more than 0%. So regardless of whether you want to have us help you with it or you do your own homework, look into that.
Money market rates are at 5. Not that they'll stay there, but they're directly tied to the Fed funds rate. So if we have, again, listen to David today and all the things that we brought up, if rates are not going to be aggressively cut, money market rates are going to stay high. If you're keeping it in your checking account, I guarantee you that you're earning probably less than 1%. I think in my checking account, it's 0.000 something. I looked at it the other day. It was very, very low. So that's it. Good opportunity. Hey, this is the first time we've had a guest. David was excellent. Hopefully you gleaned some good insights from what he said. I know we did, and it helps us sort of decipher, where we may be going in the future, which is always the important part. Like always, reach out to us with any questions. If you have any questions for David, reach out to us. We're happy to ask him. I'm sure he'd be happy to, in his busy day, he'll be able to respond at some point. And you can follow us. If you're watching this, you already know some of the places, but Facebook, LinkedIn, YouTube, our website, of course, at Strong Valley has everything posted, and it's just it's a wealth of information, and we'll keep adding to it. Last thing is, please share it. Even if you find us goofy and funny to listen to, somebody else that might get a laugh or at least get a piece of information that they didn't have before. Our goal with this is always to bring it to a layman's terms, to a client level, so you don't have to watch CNBC and watch green and red flash on the screen and hear, what was it, Jason? Soaring, cratering, rocketing. You can actually get some real information on what's happening. And again, we don't get paid by people watching our podcast. CNBC, they get paid by people watching their show. So we're trying to bring you the information that's actually relevant to you. But with that, I'll wrap it up. Thanks everybody as always for joining us. We'll have our monthly market matters in December. And until then, thanks. Appreciate it.
Have a good Thanksgiving, everyone.
Happy holidays, everybody.